Welcome back to our video sessions. And today I'm going to talk about fundamental analysis. So, fundamental analysis delves into the annual report of a company. So, what is annual report? For a company to be publicly listed, it has to showcase its performance to the investors in order to build trust among them and for the community. So in annual report, they tell us about how the company is performing over the past years and how what is the future plans of the company, how the company will perform over the next 10 years, over the next 5 years, how is the overall economy working, be it in Indian economy, if the company is having existence only in India or international economy, global economy, that what is the GDP percentage rate around the world and how it's going to impact their performance for that particular specific year. So, in this particular analysis, we delve into the actual reality, the ground reality of a company. Take an example of Adani Enterprises. So, what I'm trying to tell is that Adani is having existence in all of these sectors, and the number of stores Adani is having, the number, what is the revenue Adani company is generating, what is the profit percentage, what is the growth rate, how much every year a company is making profit. These are the things that we look into fundamental analysis. So it gives us a holistic business study. So what it is trying to tell us that what is holistic? It gives you overall how the company is performing, be it in terms of net profit, debt, how much company owes to the outsider, how much the company has to take up from the outsiders, what is the liabilities of the company, what are the assets the company owns, and at what pace it is becoming bigger and bigger. So it is estimated that Adani ports will be twice will be working on its capabilities up to twice the time what it is working today. So the company is going to be much bigger because it see a lot of exports from the India in the coming years, and it see a huge global market emerging for Indian products. So that is the amount, that is the kind of business they are into. So so in investing, you focus on the business performance rather than the stock price. At what price the company is trading right now, the investor doesn't have to care about that. The investor should only care about the business model of the company and its futuristic look, that how the company is going to go from today to tomorrow. So what is the use, what is the how fundamental analysis is useful for us? So it helps us in creating wealth. Trust me, in investments, you can only create wealth with the help of only fundamentals. Like you can create enormous wealth with the help of fundamentals. You don't have to even look at the chart patterns, how the company stock price is moving daily up and down and up and down, because this is, a daily noise of stock price that, okay, today some issue, the global issues are bad, there's something happening in the economy, there's some kind of war emerging, or there is a panic situation. So these are the things that you should consider when you are trading, not investing. What are the long term examples? So we tell that Nifty has given a CAGR of around 15-16% over these years. And some stocks have given CAGR of 30%, 40% in case of Deepak Nitrate. So what are we, at the end of the day, what we are telling, that these companies have strong business presence. So they know how to do their business and they are very best at it. They don't even care about the competition. They are having some kind of niche product, and they know that their product demand will be increasing day by day. So and in order to do all these analysis around the company, you have to look into the annual reports of the company. I'll come in the later part what is annual report and how actually it works. So just looking at the chart of TCS, I can say it is a fundamentally very good company. And look at the another chart, Suzlon Energy. Most of you would have heard about this company. The stock price is around for 54 rupees, like currently trading at 54 rupees. But you see, there's something fundamentally very wrong with the company. The stock price of this company was increasing, but at this point of time, it came down drastically. I don't have to look even, what was the news behind it. You just have to know that, okay, this is not the company that you should invest in. So this is the magic of fundamental analysis and the technical analysis combined. So both goes hand in hand. In order to make decisions, you need to look into both. But all the stock price is based upon fundamentals. Trust me that all these stock patterns charts you can see 5%, 7% up and down, 10% up today, 20% down the stock. This is because of fundamental change in the company, nothing else in this world. So understanding fundamental analysis. So what is the difference between investment and speculation? So investment it focuses on long-term business performance. That I am very bullish on Adani Ports. Like I'm not giving you a stock advice, but I'm giving you, CAMS is having a good business model where they're having 70% monopoly in case of mutual funds industry. Pidilite is having a good business because they are into all this Fevicol business where their market share is, where they are kind of monopoly in this particular sector. 60 to 70% market share is for them. In case of Asian Paints, they are into paints and like they have a huge potential to grow as well, and they have good knowledge of Indian markets that like how the paint industry is emerging. And I must trust all of you that whenever there's some kind of painting activity that is happening in your home or anywhere, like most of us would prefer Asian Paint because it's a trusted brand. So in a trusted brand, you don't have to, think about it twice because you know that the quality will be up to the mark and the product is like to its best of its capability. So this is about investment. What about speculation? So speculation is short-term price movements. So you are trying to predict that okay, after 1 month, after 1 week, or tomorrow, what will be the price of that particular price of a particular security? That is called speculation. In order to become a good investor, you need to learn about investments, not speculation. That you should not speculate after one year. I'm going to like for after 1 year, this stock is going to be at this price, and I'm going to invest in that. No, your focus should be on what type. Like you should focus on the business, how the business is emerging, and what is the potential of this particular business in context of India. So that is about investments. Can you be a fundamental analyst? Sorry. So the required skill is you have basic financial statements. Like I'll make it very easy for you to understand all of this, and industry understanding and a simple mathematics. That's what you need in order to do fundamental analysis. So there's no particular specific skills that you need not to be a accountant in order to do fundamental analysis. So what is the core satellite strategy? So the core 60% should be like of your wealth should be into long-term investments, be it in strong companies, be it in mid cap or small cap. But like there should be some kind of money that you are keeping that you are not using for speculation, because that is the because in speculation you can be incorrect, and you like there's a risk of losing that particular capital. So the strategy should be 60% should be of your investment should be in long term, and 40% should be in short term trading, because at the end of the day, the short term trading will help you to make money in order to do long term investments. So, what are the tools for fundamental analysis? First, I told you about annual reports. So, every company publish its annual report on their website in the investor section. There, from there, you can download the latest annual report, and you can look at two, three particular section, and you can just see the company how the company is performing. You don't need to read the whole 300-page annual report in order to make investment decision into that particular company. For example, if you want to invest in some kind of IT stock, what are the things you will consider? You will consider in seeing what are the competitors in the IT industry in India, Wipro, TCS, Infosys, like who are the big giants, like who have like most of the market capitalization, who are the competitions, and you look at the annual report of each of the companies before investing in. And if a particular company is telling that like they have strong some kind of business plans, and they project their net growth to be much higher than what is in the previous quarters, then you need to suspect that company, because the early part of the company shows the earlier years of the company shows that like they have 4 to 5% growth rate. Now they're telling suddenly that next quarter we'll be having 10% growth rate. That is the company you should not invest in, because they are lying to the data itself. But on a flip side, if another companies, all the competitor otherwise said that they'll be increasing their growth rate from 1% or 2%, that is kind of more realistic for me than estimating that this company is going to grow at a pace of 10%. So you need to look at all these information, small informations into the annual reports of a company. So actually, annual reports won't lie because these are fully regulated under SEBI. SEBI mandates for the company to publish their annual report every quarter and showcase how the business is performing every quarter. So every quarter, once in like four times in a year, the annual report comes into existence for a particular investor. So you need to be daily, stay updated on industry and company developments. Whatever sector you think that is going to go up over these years, you need to be, you need to daily go through the industry and company developments. That what companies like if some company is going into some kind of product development, or this something related to AI, whatever that is happening nowadays. So you can take a look and invest into those particular companies. So you need to be daily updated and useful for fundamental. So just a MS Excel is useful for fundamental calculations. You don't need to have heavy tools or some kind of coding experience in order to analyze a company fundamentally. And keep it very simple. Make your own strategy and use very basic tools, and see the chart patterns and align your fundamental analysis with technical analysis, and you are good to go. So in this section, we'll look at what is the mindset of an investor. So there are three kinds of market participants. There are three kind of people in the market, to be honest. So there are speculators who will jump into the markets as soon as they will listen some kind of news. Okay, that this company has gotten some kind of big order from a big company. VL has received 10,000 rupees crores of order, or that the price of oil is going to be decreased over the next 2 3 months. So the price, the price of Asian Paints, or say Berger Paints, is going to go up. These are the people which comes into category of speculation. That they will listen some kind of news, they will anticipate some kind of small profits, and they will try to gain short-term momentum out of the market. Next comes is trader. They will try to speculate every goddamn day. They will actually try to they will take BTSC trades in order to speculate what is going to happen in the market tomorrow on the basis of the price movement of over the past couple of days, or the price movement of today. That okay, today the Nifty has jumped up 2%. So tomorrow there's going to be a gap up or gap down. This is a mentality of a trader. So they are trying to predict short term to medium term trades, and they use certain entry points and exit points, and they're very active in markets on a day to day basis. Third kind of market participant that comes is investor. So investor thinks about long-term perspective, and they focus on purely fundamentals, and they seek steady growth and compounding returns over time. So they don't have to worry about, when they don't have the time and energy to invest in on an everyday basis to see the markets and what is the stock price up and down, up and down. They will just see the business model of a company. They'll just generally believe in the management of a company, and they'll put their money behind these companies. And investing has outperformed all these things over the past several years. And most of the people who has generated enormous wealth, they have done so in order from the art of investing. And Jim Simons is one of them who did trading and then made a lot of money like this. But most of the wealthy people, if you see, they are more into investments. They will try to find out companies which are worthy of their time and efforts. But as of now, many of us don't have the capital to invest. That's what we tell, right? Okay, I also want to invest in, but I don't have the money. So, like, in order to, understand the daily speculation that how trading works, a person can generate a livelihood. There are a lot of people that I know, they generate a lot of money out of trading and then they invest into the markets. So, it depends on situation to situation. So that's what I was trying to justify. Like, what are the different, types of market participants are there as a part of in financial market. Let's take a scenario of RBI monetary policy. Like to keep it very simple at this particular level, RBI maintains some kind of repo rate. So this is the rate at which they lend to the bank, and bank at the end of the day lends to us because RBI cannot directly lend to retailers. So let's see, there is a market scenario where the interest rate is going to go down. So the speculator will try to make money out of that. The market is going to rally because the interest rates are going to get decreased. Don't worry about this economics thing. I'll teach you in the option series that how exactly it works. So just assume that okay, in case of speculator, he's going to be bullish on the market that after there will be a interest rate cut, the market is going to rally. A trader would be skeptical at this point of time because the India VIX will be so high, like the volatility index will be so high that the option price, whatever he's dealing in, will be much more higher. So if there is any kind of sudden movements, he is going to lose a lot of premium. So what a trader would do instead, he will sell call. So again, not getting into the details. So a trader would try to make money out of the. He's expecting that there will be some kind of drop in volatility, so he will instead do option selling instead of option buying. And Girish, the investor, he will hold a diversified portfolio. He is unconcerned. He doesn't care. He don't give a damn about whatever is going to happen in the market because of this RBI interest rate cut or increase in interest rate. Because his mindset is for the long term that after 10 years I'm going to make this much amount of money. I should have a CAGR of 30%, 35%. So that is about different scenarios. So, Albert Einstein once said, I remember that, compounding effect is the eighth wonder of the world. So, what he generally means that, be it in investing, be it in anything, be it in your health, compounding works wonder. If you're doing a particular task again and again so many times, and you will be very best at it because, you will be gaining a lot of things out of that time movements. Compounding purely happens when you are holding a particular thing over a period of time. So same in case of investing. Your money, for example, if you invest 100 rupees at a 20% CAGR, the money grows, to 120 rupees after a year. But after 2 years, the money, your 100 rupees, your initial 100 will be 144, not 140, because the extra two, the extra 20 rupees you got, like from year one, will be compounded at a rate of 20%. So that will be what? 2 rupees. So one, 20, so that will, the total calculation sounds like 144, not 140. So 20% CAGR, you see the compounding effect. All of this, that money, it's making, again, that CAGR applies to the lump sum of money that you are going to make in 1 year. Again, and that process repeats, and it does wonders when it comes to investing. The longer you stay invested, the more significant the compounding effect will be. Evaluating investments. So qualitative aspects of an investment. So they're basically non-numeric. What the general shareholders will have to say about the company. What is the management say about how the company is going and growing, and what are their business plans and everything. These are about qualitative aspects. There's no number involved in all of this. When it comes to quantitative aspect, only numbers are involved into it. All these are financial statements, beat ratio, growth metrics. So these are the numbers which you can easily quantify, and you can make a wise decision out of these things. So all of these you can get in annual reports of a company, and a balanced approach will be looking at both the qualitative and the quantitative together, because once you understood how the company is performing in, how revenue, profits, everything is growing, liability, assets, now you have to understand about, like, how is the management of the company, what it has to say about the company. So, like, you have to deal in with both of these things in order to make wise investment decision. Next, we comes at I was blabbering about annual reports a lot about like on this full video, and what exactly is annual report? So annual report talk about basically qualitative and quantitative aspect of this of a company. So the annual report is a yearly publication by a company for its shareholder and interested parties. It published by the end of financial year, and data is dated to 31st March because that'll be the end of accounting period. So it is available. I told you before, it'll be available on company's website and or in hard copy. It contains official data certified by auditors. So these are not the data that company, that company come by at the end of the night, but it will be certified by the auditors of that particular company. And if there's any type of data misinterpretation in the annual reports, the auditors will be held liable because they are the ones to be trusted in these kind of information. So the primary source of information for potential and present investors. So this is a primary data. What is the objective? It provides a brief orientation on reading on annual report, like what to look in an annual report. It identifies useful information and new marketing content. So, and it identifies the financial highlights. It identifies the management statement. It identifies the management discussion and analysis. It will project the 10-year financial highlights that what was like how was the before the 10 years and how is the after the 10 years where the company will stand. It will talk about corporate information that how which particular sector the company is working in and how that particular sector is evolving and how they're evolving with it and how they're more competitive than any of them, which are the competitors. So it report on corporate governance. So you have to look basically three important things into annual report. First is management discussion and analysis. Second is consolidated financial statement. Pay more attention to the word consolidated because there are two types of financial statements that are available to general public: standalone and consolidated. Consolidated will give you the view of the company with its subsidiary together. So it will have all together the company itself with the subsidiaries. That will be the statements that are present in consolidated financial statement. Standalone will be the statements of parent company, not its subsidiary. So it will not give you a holistic view of it company that if some particular business making profit or losses, you won't be able to know. But in consolidated, you know every aspect of business. And the last is general shareholder information that what is available to the general public. Management discussion and analysis. One of the most crucial section of the balance sheet because what management has to say, what is the top leader was saying about the company is the most important because he's the owner of that company and he's looking at the company and telling that how is the company performing, how is the overall macroeconomic trend, what is the thing behind GDP, inflation, interest rates, how they are going to affect the industry and how they are better than anyone else if they are. And it analyzes the economic activity, business sentiment, and sector specific details about the company. You can comparison with peers to gauge competitive advantage. So it will, for example, Bajaj Auto will say that okay, we have performed better than any of their competitors. So that is what management discussion and analysis tells you about. You should particularly look at this particular section in the annual report and see how the what is the management take on this particular thing. Next is financial statement. So I was talking about consolidated and standalone. Look at this particular pie chart. You see, fundamental analysis consists of there's a base called annual report. So fundamental analysis is based on full annual report. It will it will be dealing with financial ratio analysis. It has a cash flow statement. It has a balance sheet. It has a profit and loss statement. So actually, these three things are super duper important: cash flow statement, balance sheet, and profit and loss statement, because it will give you overall view of the business that how it is performing. So profit and loss will tell you what are the income and expenditure of a company. Balance sheet will tell you what is the liabilities and asset the company is owning, and cash flow statements will tell you about like what are the different cash flow like where the company is spending in terms of investing, operating, financing activity, how much cash a company is having at any particular point of time. So this is about profit loss, balance sheet, cash flow. What is the purpose of this financial statement? So it evaluates company's financial health and overall performance, and it helps in decision making for investors to inform investors and stakeholders for better decision making, that they should invest into this particular company and they should be with the company or not. So now we'll be dealing, in detail with the financial statements in this full segment, because I told you these are the most three important things: profit, loss, balance sheet, cash flow. So we need to look into this in detail. So what is profit and loss statement? So it is also known as the income statement. Shows what has transpired during a specific period. It reports the company's revenue, expenses, tax, depreciation, earnings per share. So these are the things that we look into P&L statement, that where the company is getting, what are the sources of the revenue, where the company is actually earning, and what are the various expenditure. Are the expenditures going to go up? And if the expenditures are going to go up in the next couple of years, then and the revenue is not, it doesn't look that much bullish, maybe you will make a decision of not investing into that particular company because the profits will be down, and at the end of the day it is going to reflect in the share price. So in order to make all these decisions, you don't have to worry about all of these things, because it will be very much simple when I'll tell you with an example that how exactly to look and where to look. What is the purpose of P&L? It provides a summary of the company's financial performance over a particular period, and it helps stakeholders assess the company's profitability and operational efficiency. So there are revenues, there are expenses, there are earnings. Sorry. So in revenue, it represents the total income generated from the sales of goods and services. So what is the company's actual business? If I am in the business of producing these bottles and this particular bottle costs 30 rupees, and if I sold 1,000 items, the revenue of my company will be 30,000 rupees. I'm not here associating with the cost or profitability anything. Just this is the selling price of my bottle, and 1,000 rupees I sold. 30,000 means revenue. So this income is generated from the sale of goods. So it's important for assessing the company's market and position and growth potential. So if I'm able to sell more and more of bottles every year, and if I'm able to make a sustained revenue out of something, that it is growing at a pace of 10% or 5% over these years, it's a very good sign for a business, because if a company is able to generate revenue, at the end of the day, if it tries to decrease its expenditure, that company will be profitable. And you should stick to companies which are having very high revenue, to be very honest. What is the expense? So what is the expenses section show? The cost incurred in generating revenue, including cost of goods sold, operating expense, financial cost, and it helps in understanding expenses, helps and it helps in evaluating cost management efficiency. So this particular bottle again. So, for example, 20 rupees I paid for the expenses of this bottle. It includes, like the amount of money went into marketing, the sales guy that I employed in my company, and all the operating expenses and the financial cost, because I took some kind of loan in order to make these bottles, in order to set up a factory and make these bottles. So I have to, at the end of the day, pay the financial cost as well on that particular amount of loan. So all these things, all this comes under the category of expenses. So 30 rupees I was getting the revenue, and 20 is my expenditure. So what will be my net profit? As you guessed correctly, 10 rupees will be my net profit from this particular bottle. The net profit after deducting all expenses, taxes, and depreciation. So there is net profit before tax. There is not net profit after tax. So net profit before tax will be my 10 rupees. Let's say I have yearly income of around 30 lakhs, 50 lakhs. So my tax will be deducted from there. My depreciation will be deducted on my plant machinery, and after all these deduction, I will arrive at a matrix called profit after tax. And that is the most important thing because this is the amount of money that the company actually earned in a particular financial year. So profit after tax or PAT is the something that you should look into the earnings section of a company. So critical for determining the company's profitability and return on investment. Let's look at this company. So we are having a standalone this consolidate. Okay, this is a consolidated balance sheet of a company, and you can see the sales. The sales is something what we are talking about, the revenue of a company, and you can see there is a consistently the company is doing well and the revenue is growing, and these are the expenses the companies incurring. So if you see, obviously the expenses will be higher if the revenue is becoming higher, but you see the operating profit. This is the profit that it is, directly you can calculate from sales minus expenditure is the operating profit. So this is what you look at. This is what you look at, that this operating profit should grow, because even if you pay all of these things, at the end of the day, this is the amount of money that your business is generating. Whatever sales you are making, whatever expenses you are incurring to make that sales, this is the profit. So if the operating profit is growing consistently, it's a good company. And you deduct all these depreciation, you arrive at profit before tax. You pay the tax, this net profit. So net profit or profit after tax is the value, is the key matrix that you should look at. And you can see this company from 94 crore profit to 2536 crore profit in 10 years. It's a very good, though, in how many years? Yeah, around 11 years. So this is a very good sign for a company, to be very frank, that it is able to almost double its profit, no, double its profit every 2 years. That is a good sign for a company. So this is about profit and loss. So what is the revenue? So this is the screenshot from Screener. This is one of the fundamental analysis tool that you can use in order to analyze a company. I'll show you with the help of Screener only, because you can actually rely on Screener for most of the time. So I'll just go on a share, let's say PHEL. So there are like a couple of matrices that we'll just focus on PNL, because right now we are dealing into PNL. So what is this company about? The company is into integrated power plant equipment manufacturer engaged in design engineering, manufacturing, the electrical things, the power transmissions, industry, transportation, renewable energy, oil and defense. So it is into a lot of things. It's a public company, and you can see the net profit of this particular company. So this is the PNL. Okay, this is the PNL of this company, and you can see the net profit of this company. Like there was a time then the company used to make a lot of money out of net profit, but you can see the net profits are inconsistent, and actually, if you see the trend, it's decreasing. But on the yeah, there's no other side. Okay, even if the revenue is kind of increasing, but it is very inconsistent. So analyzing just these two aspects, I won't even give a penny of my money into investing into BHEL, because that's what the data shows. Even the net profit before tax is decreasing. The net profit is decreasing. So what's the like? Why is it happening? You need to delve into deep into the data, but just looking at these matrices, you can just tell that okay, you don't have to look into the company furthermore, because the company is not able to generate enough profits, and on the flip side, the profits are decreasing. So and the compound sales growth, there is -5%. So every year, every 10 years, like every year, on a year, the company is actually making it worse and worse for the investors to put their money into this company, because 100 I was selling 100 units in 2014. In 2015, I'm selling 95, and so 95, 90, 85, 80. So every year, 5% down in my sales growth. There's no use of investing into companies like this. That's what I was talking about. So you can just look at the P&L and see how the business is operating in general. Let's come back to the topic. So yeah, like that you can analyze any type of company, and like you just need to look at 5 years down the line, and if the company is able to double its net profit from 900 to actually in last 5 years from 1300 to 2536. 1, 2, 3, 4, 5, right? In 5 years, the company almost doubled its profit. That is the company that you should look for. So you just need to analyze, you just need to analyze this profit and loss treatment, and you can make a lot of analysis of your own. What's the revenue breakdown? So revenue breakdown consists of operating income and non-operating income. So it indicates the total sales and turnover generated by the company. In case of my bottle, that 30 rupees was my revenue, and how many units I sold of this particular bottle will be multiplied, and that will be my final revenue. And revenue incidental to the primary business. It includes income from secondary activities like assets or sales and service fees. So, so other operating income. For example, I'm doing some kind of investing work. I'm taking my company's capital and investing some kind of stocks or in some real estate project where I made money. That'll be other operating income, not the because that is not the primary thing that I'm doing. So it sums up the other operating income and the operating income, and it derives the total revenue of that business. So sum of the primary revenue and other operating income provides a comprehensive view of the company's income sources. So what are the expenses details? So like you can bifurcate into cost of material consumed. So what is the raw material behind producing this bottle? How much plastic I bought, or what is the plant and sorry how many sales people I required, what are the number of stores that I rented in order to sell this particular bottle, and employee benefit expenses, salaries, wages. So this comes under these are all the expenditure bill list. When you go to a restaurant, there are full list of details. What did you eat? What did you eat? So these are the details of expenses that a company occurs when it is into a business. And what are the financing costs? So I took loan, I'm paying some kind of interest on that loan, or someone is like I gave loan to someone else and they are giving me money, so that'll be my income. So these are the that'll be my other operating income. So these are the things that you'll have to look into a profit and loss statement. And then it comes about depreciation. Depreciation is like in accounts that you every year, for example, you bought a machine, and like you paid for a machine of 1 lakh rupees, and you know that 10 years down the line this machine is going to be obsolete, like there's no use of this machine. So every year you will deduct 10,000 rupees from your expenditure. That is the thing that you will take into consideration, because after 10 years again you have to buy a new machine. So because if you deduct this particular expenditure from your profit and loss, you don't have to pay the amount of tax. You have to pay less of a tax. So this is about accounting principles. I don't have to get into details of it, but for the information, I was talking about how depreciation in general works. So depreciation and amortization is an expenditure for a company. So similar allocation for intangible assets. So that is same for every year. I'm deducting some kind of amount from the profit and loss and showing it as an expenditure of a company to match the expenses of using an asset with the revenue it generates. So, because at the end of the day, you are using that particular asset, you are using that particular plant or machinery in order to make goods, in order to generate revenue. So, it is considered as a revenue expenditure. So, it provides a more accurate picture of the company's profitability, and it reduces the book value of assets on the balance sheets. Every year you have to you can lower the value of your plants and machines, and it affects the net income. So it increases your sorry, it decreases your net income, because you're taking you're considering it as an expenditure. So at the end of the day you are deducting it from your profits. What is profit after tax or net profit? Same thing, right? It calculated as profit before tax minus the applicable taxes. So whatever your operating profit, then you deduct all these depreciation, amortization. You come at a figure called profit before tax. You deduct the tax, you get the net profit after tax. And this is the thing. This is something that you should look at. That's what I suggest. And a simple rule of thumb. It's nothing. Every 5 years it should double. Earning per share. It measures the profit attributed to each outstanding share of a common stock. So earning per share, if the earning per share is increasing, that is a good sign for a company. And per share. What's the formula behind this? So net profit before tax. So this net profit after tax divided by the total number of outstanding shares. So on every one share, what is the profitability of a company? So what is the profit divided by the total outstanding share will be the EPS. If the EPS is into upward trend, it's a good company because it's able to generate more and more of income for the business. Important metrics for investor to gauge company's performance. So the conclusion of this particular series is that how financial statements can be helpful and they are useful to make investment decision, and you should look into all these financial statements before investing into any particular stock, and you should consider so this is about quantitative aspect. Now we are talking fully about what exactly to look into the quantitative aspect of it. In the next video, first I will go to the annual report of some company, and then I'll show you what is the management details, what is the management and discussion, and what we can derive from the management view of a company, and then we will look into what are remaining balance sheet and cash flow statements, so about for the consolidated financial statements. Thank you for watching and stay tuned for more sessions.